Imagine waking up one morning, logging into your online banking, only to find your money gone. Not stolen, not hacked, not transferred by mistake, but taken, legally, by the very institution that promised to protect it. Most people believe that the money they deposit in a bank is theirs. Safe, untouchable, guaranteed. But there is a hidden law, quietly embedded in financial systems across the world, that says the opposite. A law that allows banks, during certain conditions, to seize your money, turn it into their own assets, and leave you with nothing more than a polite PDF explaining why it was all necessary. It's a law banks hope you never learn. A law most depositors still don't understand. And a law that once triggered, spreads through the financial system like a slow, silent earthquake. Today you will learn exactly how it works. Because once you see the truth, you will never look at your bank the same way again. To understand this hidden law, we need to travel back, not decades, but centuries. The modern banking system was never designed as a vault. It was designed as a lever. Depositors see security. Banks see liquidity. Lawmakers see stability. And financial elites see opportunity. At the center of it all sits a deceptively simple idea. When you put money in the bank, it no longer belongs to you. Legally, it belongs to the bank. This principle, rooted in English common law and later adopted worldwide, reshaped the entire financial industry. Banks became legally allowed to lend out your deposits, invest using your funds, use your money as collateral, convert your deposit into a bank-issued IOU. And most people still believe the money is theirs. Throughout the 20th century, this wasn't a huge problem. Why? Because governments created deposit insurance systems to maintain trust. But trust is fragile. And in 2008 it shattered. That's when lawmakers quietly introduced something far more controversial, the legal foundation of what we now call bail-in. A bailout is when governments rescue banks using taxpayers' money. A bail-in is when banks rescue themselves, using your money. Today, we explore the story behind this transformation, the origins, the rise, the breaking point, the fallout, and why the same danger is quietly returning. The roots of this hidden law start with one fundamental truth. When you deposit money in a bank, you're not storing your cash. You are giving the bank a loan. Most people never realize this. But legally, your deposit is an unsecured loan to the bank, the same type of debt category as a credit card or an unpaid invoice. This legal structure came from historical court rulings in England in the 1800s. Judges ruled that once money enters a bank, ownership transfers to the bank itself. Why? Because banks argued they needed full control over deposits to lend, invest, and support economic growth. Governments agreed. The courts agreed. The financial elite agreed. And the people never understood what they were agreeing to. Fast forward to the 20th century. Banks expanded rapidly. Deposits exploded. And the world grew reliant on a system built on a simple promise. You'll get your money back. But this promise came dangerously close to collapsing in 2008. The rise of the modern financial crisis began with risk stacking on top of risk, banks over-leveraging deposits, risky mortgage-backed securities, legal loopholes allowing reckless investments, regulators asleep at the wheel, politicians preaching stability while the system cracked. When the 2008 crash hit, major banks were days away from insolvency. The public believed their deposits were safe. But behind closed doors, lawmakers were panicking. They faced an impossible dilemma. Let the banks fail and destroy the economy, or use taxpayer money to save them. Governments chose bailouts. Trillions were injected into failing institutions. But politicians faced backlash. People were furious. Countries nearly collapsed under public anger. So behind the scenes a new plan was created. A plan that would ensure governments would never again be forced into bailouts. A plan that would shift the burden from governments to you, from taxpayers to depositors. This plan was the groundwork for the hidden law we know today. The breaking point arrived in 2013, in the small Mediterranean country of Cyprus. Banks there had made massive, reckless investments using depositor funds. When they collapsed, something unprecedented happened. Depositors woke up to find their savings frozen. And soon, a portion of their money was taken, permanently, to rescue the banks. For the first time in modern history, a full-scale bail-in was executed. People lost 10%, 30%. Some even lost over 60% of their life savings. not because they did anything wrong, but because the law allowed the bank to convert depositors' money into bank capital. Cyprus became the legal experiment, and regulators around the world secretly took notes. Because from the perspective of lawmakers and financial institutions, bail-ins work. They're fast, they are controlled, they don't require taxpayer money, and they keep banks alive. So one by one, countries began implementing similar laws. Europe, Canada, Australia, New Zealand, the United States, quietly through the FDIC's crisis resolution powers. The hidden law had officially gone global. The fallout of this shift was enormous, yet almost invisible to the public. Banking laws worldwide were rewritten to classify depositors as unsecured creditors. This means that in a crisis, shareholders lose money, bondholders lose money, but depositors also lose money. In some jurisdictions, even insured deposits can be frozen. The consequences are staggering. 1. Depositors can legally lose everything above insurance limits. In some frameworks, even insured amounts can be delayed or restructured. 2. Banks no longer need taxpayer bailouts. Your savings become the bailout. 3. Financial institutions have legal cover to seize funds, not as a crime, but as a regulatory necessity. 4. Most people still don't know this law exists. Governments rarely explain it. 5. Financial stability is now built on depositor sacrifice. The system assumes the public will remain silent and confused. And the most chilling part? In many countries, once a bail-in begins, you cannot withdraw your money. You are frozen out, while the bank restructures your deposit into bank equity. In simple terms, your money becomes their money. After Cyprus, after 2008, after every crisis, policymakers promised, this will never happen again. So they introduced reforms, tighter regulations, stress tests, minimum capital ratios, liquidity rules, new crisis management frameworks. But here's the truth. Many of these reforms failed, or even made things worse. 1. Banks became more complex. Too complex for regulators to monitor. 2. Legal loopholes increased. Institutions found new ways to hide risk off balance sheet. 3. Crisis tools strengthened bail-in powers. The correction expanded the exact mechanism meant to protect us. 4. Deposit insurance remains underfunded everywhere. Most insurance systems can only cover a fraction of deposits in a real crisis. 5. Financial risk is bigger today than in 2008. Leverage, derivatives, and debt are all at all-time highs. Instead of eliminating the danger, the system quietly shifted it onto the one group with no legal protection, the average depositor. The hidden law isn't just history. It's happening again. Today, banks around the world hold record levels of derivative exposure, unrealized losses, commercial real estate risk, sovereign debt instability. Several major institutions have already failed in recent years, and bail-ins are being openly discussed in economic papers, regulatory speeches, and banking conferences. Most viewers don't realize this. The next crisis will not look like 2008. It will look like Cyprus, but bigger. For example, European bail-in rules allow deposit confiscation above €100,000. Canada's bail-in regime covers major banks and depositors over insurance limits. Australia explicitly includes deposit liabilities in bail-in scenarios. The US FDIC has crisis powers enabling depositor restructuring under certain failures. And the risk today is higher because interest rates are high, banks are squeezed, commercial real estate is collapsing, debt levels are unsustainable. Regulators know taxpayers won't approve bailouts again. So the hidden law isn't just a possibility. It's already written, documented, ready to activate when needed. And almost nobody is prepared. Before we end, here are 3 critical lessons everyone should understand. 1. Your deposits are not legally your money. Once your cash enters the bank, it becomes a bank liability, a promise to repay, not stored personal property. Understanding this changes everything. 2. Deposit insurance is limited and not guaranteed in a major crisis. Insurance funds cannot cover mass failures. In a systemic event, delays, freezes, or losses are not just possible, they are legally allowed. 3. Bail-ins are the new global policy. Governments have already decided the next banking crisis will not be paid by them. It will be paid by depositors. The best protection is awareness, diversification, and understanding the system you rely on every day. Now, if you found this breakdown valuable, if it opened your eyes, or if you want more deep investigations into the laws, loopholes, and financial systems that shape your life, make sure you subscribe, drop a comment, and let me know what hidden financial law you want me to uncover next. Because the truth is simple. What you don't know about your money can cost you everything.